Good morning, everyone. It's Ben Buckner and Dan Bossy with Ag Resource Company in Chicago. It's Monday, June 23rd, and geopolitics and weather seem to be driving markets this morning. Of course, we had a lot of geopolitical news over the weekend, but I think most importantly, we're waiting on crude oil to give us direction, and crude oil seems to be mostly unfazed by what's happened between the West and Iran in terms of missile attacks over the weekend. And we'll kind of break down what we think may happen. And, I think Iran might be kind of limited in their retaliation is the message, at least this morning. So to us, Dan, I think it's just kind of back to basics in the ag markets. And it's fundamentally driven, at least so far this week. But what do you have for us this morning?
No, I think that's right, Ben. We're going back to the basics of fundamentals, which is weather and probably export demand. We did open $3 higher in crude oil last night on the attack on Saturday relative to U.S. Nuclear facilities in Iran. However, since then, the crude oil market's been coming down. And so as you think about what's going on, Ben, I really believe that although Iran is promising retaliation, we don't know what that retaliation will look like. They're suggesting we will end this war. Well, I'm not sure how that would happen, but I do think there's really three scenarios that could play out. Number one, Iran could basically surrender now. I mean, they're between the Israeli strikes and the U.S. strikes, there's a lot, of course, rubble that's being created in Tehran and other cities. We don't think at the moment anyway that Iran will allow themselves to become the next Gaza. But that being said, surrender with this religious clerks that are there is probably unlikely. So I don't think that's a high end probability. The other one they could do is go big. Let's say we go big and let's say we close the Gulf of Hormuz and we have some very targeted attacks against the U.S. military bases in the Mideast. That would be going big, at least at this juncture, with missile attacks. But again, I doubt that also, as the Fifth Fleet from the U.S. is already monitoring the Strait of Hormuz. They've got minesweepers in the area. So I think as you think about that option, it's probably unlikely also amid all of the productive capacity of crude oil that's still available in the world. So maybe something in the middle that would be like a very targeted attack on the United States where missiles fail. And of course, the ongoing Israeli missile attacks where aircraft come back from Israel and, of course, do impact Iran going forward. I think that's the probable move, which is what we saw last week and probably will continue. That being said, as you look at crude oil prices, maybe if we got a partial close of the Hormuz Strait, we could make it up to $80 or $82 a barrel. I don't think that would get the grain markets going. The other chart on the other side is the CRB index. The CRB index is indicating that as of today, we're just testing the 2022 highs relative to strong livestock prices, metals prices, and of course, energy prices. And that's taken us back to those highs when inflation was running over 6%. I think today is different. This is a supply shock rally, not something that's lasting. So I believe without inflation that 2022 high will last, and we'll see the CRB or commodities pull back generally as we think about forward pricing in forward months. Now, the U.S. corn market this morning is down again after being higher last night following crude oil. Corn is anywhere between, let's call it 4 to 5 cents lower. You're seeing this pennant that we've been pointing out for the last couple of weeks. That red line, we're breaking out to the downside. July corn is nestled against its contract low from last summer at about $4.21 a bushel. As you look at December corn, we need to hold support at 434 to 435. Those will be key numbers here today. But you can see in that red line, July corn is poking below that. Now, if indeed we close the week below that trend line, I start looking at a downside target between 390 and 395, which is that gap level going back to last September. That'll be the key area. But with weather being favorable, it's hard to see a strong corn rally as we look at a record large new crop and the abundance of supply around the world. The functionality of corn, if you look backwards in time when we reached July, was to make sure we had a big Brazilian crop, and we've now done that. We believe that Brazilian crop is somewhere between 135 and 139 million metric tons, potentially a record, and large U.S. corn seedings, and we do believe that also occurred with that rally to $5. But in the casualty of boosting Brazilian production and U.S. production, notice that world corn trade here has slumped. This is a 7-country major exporter corn trade. Notice from February up until June, we're about 12 to 14 million metric tons below the year prior. So this is concerning, and this is just a casualty, if you will, of that high price that we saw in corn. The United States corn export profile is now coming down. Brazil is becoming more aggressive. Argentina is a low-cost seller in the world. So we would imagine that this stale corn export profile will persist. If it does jump higher in June, July, and August, it's going to be because of Brazilian corn export sales and their future aggression. I would also mention from Friday, we had weekly export sales reports, and we are now looking at new crop soybean sales at their second lowest level on record. This, of course, is due to the trade fight that's going on between the United States and China. So if we're to see this sales pace of new crop beans improve, we need a trade deal. At the moment, that seems unlikely as we look forward for the next 3 to 4 weeks. I'm not even sure there's any talk scheduled, but we need to get some kind of ratification of a U.S.-China trade deal by the middle of August, or we're going to see further slippage in U.S. soybean export demand. I think this is very key for the soybean market longer term. In fact, more important than renewable fuel obligations, just because if we don't have China as a significant importer, that could trim somewhere between 200 and 300 million bushels from the U.S. export profile for the 25-26 crop year. Finally, Ben, we'll finish off here with a little bit on weather. Central U.S. heat will persist for another 3 days across the far eastern Midwest. Monday, Tuesday, Wednesday, it's already waning in the west from showers that are occurring across Iowa, Minnesota, and the Dakotas. So we've got another 2 to 3 days of very extreme weather. We think this has helped the crop root down. I don't think there was a lot of stress at this point. Assuming the rains and more seasonal temperatures arrive, actually the heat will be favorable to corn production and yield prospects going forward. That being said, we need to get the rain, and we are seeing showers across the northern parts of Iowa and southern Minnesota here this morning. As you look at this graphic right here, this is 7-day rainfall. And as you look at the graph, you can see that Iowa really gets covered up with a fair amount of rain, along with portions of eastern Nebraska, southeast South Dakota, Minnesota, Wisconsin, and northern Illinois. This is the area that really needed the rain. This area has been dry, so Mother Nature couldn't place it any better than what we're looking at for the week ahead. We'll see how this all comes forward, but a good 2 to 4.5 inches of rain across Iowa would really set their crop up nicely, with corn good to excellent ratings at 84%. That would really get us going into pollination in a very positive step, Ben. So back to you, but I don't see anything this morning that really gives me confidence that the corn markets or these grain markets can sustain a rally without adverse central U.S. weather.
Yeah, I think that's right too. I mean, the last 2 slides you showed probably are what's driving the market so far this morning, especially thinking about corn. It's very simple. We planted 5 or 6 million additional acres. So it's very tough to kind of come up with a scenario and that the corn balance sheet tightens. I think just calendar dates too. I mean, every week that passes that you don't see a big weather threat, you kind of check off a box, and June will not have been bad. We're now starting to peak into the first couple of days of July, mild-ish and wet in a lot of places. So we're getting closer to pollination, and the market understandably extracts a little bit of premium every week that goes by. So I think that's probably still the focus at AgResource, at least, is going to be central U.S. weather, cash markets, and we don't see kind of a disruption to the seasonally bearish trend moving forward. So as always, all the best in the markets. Dollar gets in for 30 days. We're still defining, the parameters for new crop supply and demand this week. So be sure to check that out, and good luck in the markets today.